In our last video, we talked about how to put together a single-step income statement. And basically what we did was we took all our revenues and we subtracted all our expenses, and that gave us our net income. But the problem with that was that we just laundry listed all our revenues and all our expenses, and we didn't take the time to break them into different categories, which might be informative about telling us which types of expenses are likely to recur in future periods, right? So if you have a one-time gain or loss on the sale of an asset, you might not expect that to recur the next year. Whereas if you have revenue that's from sale, that would be expected to recur year after year, because that's how a firm makes money, by selling products or services. So let's put together a multi-step income statement, and we'll compare and contrast how it relates to a single-step income statement. So I've got a list of accounts here for you, and we're going to use these accounts to create a multi-step income statement. But let's first take a look at these accounts. This is not a trial balance. This is just a list of accounts. But I want you to notice a few things. First of all, dividends should not be included in our income statement. So I'm just going to cross that out. I just included this to make sure that you understand that dividends are not an expense and they don't belong in an income statement. And also you see here unearned revenue. Remember, that's a liability. So just because it has the word revenue in it doesn't mean that it belongs in an income statement. So everything else that we have here is going to belong in our income statement somewhere. And the question is, how do we organize it? Well, what we're going to start with is we're going to start with our top line is going to be gross sales. But first, before we do any of that, what we need to do is we need to create this income statement in good form. So we're going to need the name of the company, and let's say that the name of the company is Edible Pizza Boxes. Let's say you do some research and you find that 90% of people are still hungry after they finished eating a pizza, so you decide to make an edible pizza box that they can just eat the box itself when they're done with the pizza. So Edible Pizza Boxes, income statement, and let's say it's for the year ended, I don't know, let's say December 31st, 2018. Let's just throw that date out there. So this is the heading for our income statement. And so we're going to start with gross sales. So we're going to start with sales. Now where is our gross sales here? Sales revenue. That sounds like gross sales. So we've got $550,000. So we're going to say $550,000 of sales. We're going to cross that off. Now we know we've done it. Now we need to get to net sales. Now how do you get to net sales? We're going to subtract any sales returns or discounts. And we have both here. We have sales discounts, then we have sales returns. So let's subtract them out. So we've got less, and this just means minus, less sales discounts of 10,000, and then sales returns of 3,500. So when we subtract those, that gives us 536,500, and this is our net sales. Net sales. That makes sense, right? If we gave discounts or people return products, we should subtract that out. Was what we really care about is net sales. Now, we're going to subtract next. Well, let me just cross these out, make sure we don't double count anything here. We're going to do next cost of goods sold. Cost of goods sold is coming up next. So here's our cost of goods sold. It's $217,000. So I'm just going to abbreviate it COGS. And I'm going to put it in parentheses so that you know that it's being subtracted. Okay. Now, that is going to give us, if we subtract 536,500 minus 217,000, that's going to give us $319,500. And we have a special name for this. This is just a subtotal. It's called our gross profit. So this is nice. When we did the single step income statement, we don't calculate any kind of subtotals. All we do is just take the revenues minus the expenses. But now we've got this gross profit. And we can compare, let's say we're comparing two grocery stores. we could say, okay, what's the gross profit for each grocery store? Before we get into the bottom line of net income, we can compare this subtotal and see which firm is performing better in terms of its gross profit. And then we could even divide the gross profit by the sales and come up with something called the gross margin percentage. But we'll get into that in another video. So now next up, let me just make sure we cross out cost of goods sold. Now we want to deal with operating expenses. And operating expenses, normally the main thing that comes to mind when I think of operating expenses are SG&A, selling, general, and administrative expense. But that's not the only thing. So we've got selling expense of $45,000. So selling of $45,000. And then we've got this general administrative. That's like salaries and stuff for the CEO, G&A, and that is $122,000. And then we also have rent expense. So rent generally is an operating expense, and that's $16,300. Okay, so that's rent. And now we're going to have another subtotal. And this subtotal is going to be called operating profit. Operating profit. And our operating profit is going to be $136,200. All I did was just take the $319,500 and then subtract these three operating expenses to give us our operating profit. Now, after the operating profit, you're going to have a section called, this is going to be called non-operating items. Non-operating items. And if different firms do things in different ways. So for non-operating items for this firm, since we sell edible pizza boxes, things like interest revenue and interest expense are going to be non-operating items. And we can net those together, that $11,000 and the $7,500. We can just net them together, and we'll call it interest income. You'll see firms do this. They just net it together. Interest income of $3,500. That's going to be added because we had more interest revenue than expense. But if this was a bank, then the main way that a bank makes money is by loaning out, making loans and getting revenue from that, right? Getting interest. So for a bank, interest revenue would actually be up by the top. But because we're selling pizza boxes, this is a non-operating. It's not part of our core operations to make money from interest, right? It's just we had some income on some investments or something. So let me cross out these things here and make sure we don't double count anything. Now we're going to have, see this impairment? When we have an asset impairment, usually that's a non-operating charge as well. For some reason we had to write down the value of one of our assets. So I'm going to put this impairment expense here. And there would be a reduction. And now that's going to lead to our income before income taxes. Income before tax. And that's going to be $135,900. Now we need to do tax expense, and so I've given you, we'll assume here the tax rate is 40%, and so we'll just multiply that 40% by 135,900, and that's going to give us $54,360. That's our income tax expense. And so now we know we deduct that, and let me just put the subtraction there. So we deduct that, and then we're going to have our income from continuing operations. If we didn't have any discontinued operations, we would just call this net income. Oh, back up. Continuing operations. Okay, that's $81,540. Now, notice that we have a discontinued operation. What that means is that we sold off one of the segments or divisions of our business. So let's say that we had a segment that made edible grocery store bags, right? You get those plastic bags when you're at the grocery store, and we said, you know what, we want to sell this operation, and we sold it to another company. Well, we break out, when we do a multi-step income statement, we want to break that out, because if an investor is looking at our income statement and they want to predict the future earnings of our firm, do they want to be looking at some discontinued operation? No, they don't care about that, because we want to break this out and say, hey, this is separate. This is separate. We got rid of this business, so any income from that business or any gain we had on the sale, you don't want to be looking at that, because that's not relevant in terms of predicting the future for this firm, right? So now we're going to do the discontinued operations, and we're going to do this net of tax. So here's how it works with this net of tax. We do multiply it by 1 minus the tax rate. So this is multiplied by 1 minus 0.40, and then this is multiplied by 1 minus 0.40. Now you notice there are two things for discontinued operations, and the reason is that you have the actual income from that division, right? Because that division could have had a gain or loss, or they could have had a profit or loss, during the period. So this $29,000 means that the edible grocery bag business made $29,000 profit on its own, on a standalone basis. So we're going to back that out. We're going to multiply it by 1 minus the tax rate. And then we had a gain. The gain is different from the profit or loss of the division. It's just from selling the division, we actually recognized a gain. We could have recognized a loss. You could have where the division actually had a profit, but you recognize a loss on the sale. So we're not going to get into that. We'll talk about that in another video. But we multiply each of them by 1 minus the tax rate, and then we're going to present them separately. So we're going to have discontinued operations. And I present the solution here in a nice cleaner format than my handwriting, so I'll get to that in a moment. So discontinued operations, and we're going to have 17.4, which is this is the profit of the division, and then we have the gain on the sale. The gain on the sale is $2,760, and then our net income, our grand finale net income, is going to be $101,700. So this firm had a profit for this period of $101,700. Now, I presented it here just so you can see it's a little cleaner than my handwriting. Now, if you take a look at all the information that we get here compared to a single-step income statement. Remember, single-step income statement, we just say revenue, like all the different types of revenue, minus all the expenses, net income. Now, in each case, we get the same net income, right? So net income is no different. The key is that we can look here and we can say, hey, look, $17,400 of the profit of this $101,700 was due to the profit of a division that has been sold, right? So we wouldn't expect, if we're looking, okay, well, next period, is it going to be $101,700? Probably not, right? Because we got rid of a division that was accounting for almost 20% of the profitability. And we can look and we can say, okay, there was an impairment here, and how likely is that to recur, and so forth. And we could also look at things and say, wow, do we think there are way too many discounts, or are there way too many sales returns? And so we're really getting to we got all these different subtotals of gross profit, operating profit. And some firms will look and say, you know what, you don't want to pay attention to what's going on down here. So this area between operating profit and this here, these are like one-time items, or this impairment charge, this isn't likely to happen again, and so forth. And so we'll try and get you a focus on the operating profit. And sometimes they will bury things that are likely to recur and try and push them down the income statement to get them into this section, so they kind of trick investors into thinking, hey, don't worry about that, just focus on the good number up here, right? And so you need to use your judgment when you evaluate an income statement. But you see here that a multi-step income statement is a lot different than a single-step income statement, because we're getting the different subtotals, gross profit, operating profit, and then we can use these. We can calculate the gross margin percentage. We can do it as a percentage of sales, and then we can calculate operating profit as a percentage of sales. That'd be called operating margin percentage. And then you could even calculate net income as a percentage of sales too. So we're getting a lot more information with a multi-step income statement. It's a lot easier to make predictions about what the firm's net income or operating profit will be in the future, as opposed to just using a single step income statement where we just laundry list all the revenue, laundry list all the expenses, and get the net